Have you ever wanted the relative safety of a mutual fund without the fees and restrictions tied to it? If so, then your answer may be an ETF. Exchange-traded funds, or ETFs, are an easy way to begin investing. ETFs are fairly simple to understand and can generate impressive returns without much expense or effort. Hi, I'm Kate from The Motley Fool. I'm going to explain what you should know about ETFs, how they work, and how to buy them. An exchange-traded fund, or ETF, allows investors to buy many stocks or bonds at once. Investors buy shares of ETFs, and the money is used to invest according to a certain objective. For example, if you buy an S&P 500 ETF, your money will be invested in the 500 companies in that index. One common question is, how do ETFs and mutual funds differ, since the basic principle is the same? The key difference between these two investment vehicles is how you buy and sell them. Mutual funds are priced once per day, and you typically invest a set dollar amount. Mutual funds can be purchased through a brokerage or directly from the issuer, but the key point is that the transaction is not instantaneous. On the other hand, ETFs trade just like stocks on major exchanges, such as the New York Stock Exchange or NASDAQ. Instead of investing a set dollar amount, you choose how many shares you want to purchase, because they trade like stocks. ETF prices continuously fluctuate throughout the trading day, and you can buy shares of ETFs whenever the stock market is open. But before we get into the details, there are a few concepts you need to know before you buy an ETF. Passive versus active ETFs. There are two basic types of ETFs. Passive ETFs, also known as index funds, simply track a stock index, such as the S&P 500. Active ETFs hire portfolio managers to invest their money. The key takeaway: passive ETFs want to match an index performance. Active ETFs want to beat an index performance. Expense ratios. ETFs charge fees known as expense ratios. You'll see the expense ratio listed as an annual percentage. For instance, a 1% expense ratio means that you'll pay $10 in fees for every $1,000 you invest, so a lower expense ratio will save you money. Dividends and DRIPs. Most ETFs pay dividends. You can either choose to have your dividends paid to you in cash, or have them automatically reinvested through a dividend reinvestment plan, or DRIP. Now, let's talk about the taxes in an ETF. If you buy ETFs in a standard brokerage account, not an IRA, you should know they could result in taxable income. Any gains you make from selling an ETF will be taxed according to capital gains tax rules, and any dividends you receive will likely be taxable as well. Of course, if you invest in ETFs through an IRA, you won't have to worry about capital gains or dividend taxes. In a traditional IRA, money in the account is only considered taxable income after it's withdrawn, while Roth IRA investments aren't taxable at all in most cases. So how much money do you need to be able to start investing in ETFs? ETFs don't have minimum investment requirements, at least not in the same sense that mutual funds do. However, ETFs trade on a per-share basis, so unless your broker offers the ability to buy fractional shares of the stock, you need at least the current price of one share to get started. Now let's talk about the pros and cons of ETFs. The advantages to investing in an ETF. ETFs provide exposure to a variety of stocks, bonds, and other assets, typically at minimal expense. ETFs take the guesswork out of stock investing. They allow the investor to match the market's performance over time, which historically has been quite strong. ETFs are more liquid, easy to buy and sell than mutual funds. Online brokers make it easy to buy or sell ETFs with a simple click of the mouse. It can be extremely complicated to invest in individual bonds, but a bond ETF can make the fixed income portion of your portfolio very easy. What are some of the drawbacks to ETFs? Well, since ETFs own a large assortment of stocks, they don't quite have as much return potential as buying individual stocks. ETFs are often low cost, but they aren't free. If you buy a portfolio of individual stocks on your own, you won't have to pay any management fees. Now let's talk about the steps on how you should start investing in ETFs. Let's break those down into three categories. Open a brokerage account, choose your first ETF, let your ETF get to work. Number 1. Open a brokerage account. You'll need a brokerage account before you can buy or sell ETFs. The majority of online brokers offer commission-free stock and ETF trades, So cost isn't a major consideration. The best course of action is to look at each broker's features and platform. If you're a new investor, it may be a good idea to choose a broker that offers an extensive range of educational features. Number 2, choose your first ETF. For beginner investors, passive index funds are generally the best way to go. Passive index funds are cheaper than their actively managed counterparts. And the reality is that most actively managed funds don't beat their benchmark index over time. With that in mind, here's a list of ETFs and a brief description of what each invests in for beginners who are just starting to build their portfolios. Number 1, Vanguard S&P 500 ETF, Schwab US Midcap ETF, Vanguard Russell 2000 ETF, Schwab International Equity ETF, Schwab Emerging Markets Equity ETF, Vanguard High Dividend ETF, Schwab US REIT ETF, Schwab US Aggregated Bond ETF, Vanguard Total World Bond Fund. You might have noticed that this list is a little heavy on Vanguard and Schwab, but for good reason. Both are dedicated to offering Americans access to the stock market at minimal expense, which is why their ETFs are among some of the cheapest in the business. Step 3. Let your ETF get to work for you. It's important to keep in mind that ETFs are generally designed to be maintenance-free investments. Newer investors tend to have a bad habit of checking their portfolios far too often and making emotional knee-jerk reactions to major market moves. In fact, the average fund investor significantly underperforms the market over time, and overtrading is the main reason. So once you buy shares of some great ETFs, the best advice is to leave them alone and let them do what they're intended to do. Produce excellent investment growth over long periods of time. I hope this video helps you on your investor journey. At The Motley Fool, our purpose is to make the world smarter, happier, and richer.